In an M&A transaction, would you rather do a stock sale or an asset sale? This is a little bit more advanced, but these topics or stuff related to this could come up in any high finance investment banking interview. We're going to get into it in under 3 minutes. Now, we know that this is a transaction, so it means there's a buyer and a seller. And for stock versus asset-based purchase, there are going to be pros and cons for both. If we have an asset purchase, think about what this means. It means that we are purchasing assets from this person, not the whole company. So for the buyer, this is going to be advantageous because one, you get to pick and choose what you want. If I have 3 factories and 2 of them make $100 million a year and one of them makes $5 million a year, I might only pay for the 2 that make a lot more money. And that way I'm going to get the better resources and I don't have to pay for extra stuff that's not really going to drive my return on investment. Another thing that makes a stock sale advantageous for a buyer is, let's say you're buying a table and the table costs the seller $100 and you buy for $200. You can now have a depreciable basis of $200. So you just double your depreciable basis, which means that you're going to have to pay less in taxes because depreciation is tax deductible. This is called a step up in finance, and this essentially means you're stepping up the value of an asset, which means you can depreciate it for more because it's worth more. Now, an asset sale is going to be less beneficial for whoever is selling the company for a few reasons. The first one being, if they have a C Corp, which is a corporation, that means it's a sole entity of a business. So if they sell the business, those proceeds that they get, those earnings they get from selling the business have to be taxed at the corporation level. And then as they take on their own personal income from that sale at their level. So they're due for double taxation, which no one likes. And in addition, if you have a dude just picking off, let's say, all of your factories except for 2, now you have to figure out how you're going to close out the business with these 2 random little factories that nobody wants. Now, let's say we have a stock sale. As you probably guessed, this is going to benefit the seller more than the buyer. Because in a stock sale, let's say you own the company. When you sell it, you don't have to worry about them picking assets or negotiating prices. They are buying your whole company, which means once you give them their stock, you're completely done. You don't have to worry about anything else to do with company processes. Generally speaking, of course, you could have something like an earnout. As the seller, you also are only going to get taxed once because the income you get is going straight to you as a shareholder and not to your business first, like a C Corp, and then to their shareholders because there's no more business. It's now owned by someone else. Now, some of these pros flip on the buyer side because let's say you're purchasing this business for full stock. That means you're also taking along all the liabilities that come along with the assets you want, and you can't pick and choose, which means efficiency or profit margin might be affected a little bit. You also have to take into account that when we're talking about a asset sale versus a stock sale, because in a stock sale you're not getting that step up and that increase in depreciable basis for a piece of equipment, this is not a benefit to the buyer because they're missing out on tax-based savings. There's definitely some other advantages and disadvantages for each party, but generally speaking, a stock-based sale is going to be a little bit more advantageous for a seller versus in an asset-based sale, which is going to be a little bit more advantageous for a buyer. If you enjoyed that, you can click the follow button. If you have any questions, throw them in the comment section.